Gold just ripped to a new all-time high of over $3,500 per ounce. Bitcoin's green today, stocks are down, and the setup feels strangely familiar. Because if history is any guide, when gold rips, Bitcoin usually follows. The question is, when? And what will be the trigger this time? Could it be the Fed finally submitting to political pressure and cutting interest rates? Or foreign central banks quietly shifting away from Treasuries into gold? Today, we're going to break down gold's breakout, what it signals about monetary policy, why central banks are rotating reserves, and why all of this could be setting up for the most explosive handoff from gold to Bitcoin yet. Welcome to No Second Best, the show where conviction meets reality, and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. Gold didn't just move on this Tuesday after Labor Day, it surged. This morning, spot gold soared over $3,500 per ounce, taking out its old high and confirming that the market is still hungry for monetary hedges. At the same time, Bitcoin is up modestly, about 1.5%, while the major equity indices are red across the board. And this dynamic matters, because gold and Bitcoin are both trades on fiat debasement. Both are signals that investors are losing trust in paper promises. And time again, gold has led the move, and Bitcoin has followed. As Macroscope pointed out on X this week, there's a repeating lead-lag relationship. Gold moves first, Bitcoin follows later. Why? Because Bitcoin trades with an equity-like risk premium in the short term, while gold is the familiar hedge that institutions buy instinctively. Back in April, the same thing happened. Gold pushed into the 34 to 3,500 zone, just as Bitcoin was pulling back hard. That inflection marked a positive divergence, and soon after, Bitcoin ran to new highs. Now, we don't know if the timing will rhyme perfectly again, but the pattern is clear. And right now, the Trump administration is continuing to apply massive pressure on the Fed to cut rates. Politicians love to spend, and cheaper borrowing makes it easier to run bigger deficits. The problem? Inflation risk is still alive, which means the push for easier money isn't just politics. It's also a direct threat to the credibility of the dollar. All else equal, less independence at the Fed means more money printing, more debt, and more currency debasement. Markets aren't waiting for permission. They're reacting in real time, and this gold breakout is Exhibit A. And it's not just me saying this. Here's Jeff Park, Chief Investment Officer at ProCap BTC and advisor at Bitwise Asset Management, speaking with Natalie Brunell on her Coin Stories podcast. In this clip, Park lays out exactly how the Fed abandoned real market discipline after 2008 and why Bitcoin is the scarce alternative.
One amazing stat I will share with you is the balance sheet of the Federal Reserve back in 2008 was something close to $900 billion.
Yeah. And then it went to trillions.
Yeah. And so that's about 6% of GDP. And if you were to equate that growth linearly with our GDP growth as we've experienced for 20 years, that balance sheet should be roughly around $1.5 trillion. Today, it's not $1.5 trillion. It's $7 trillion, which means it's 20+% of our GDP. So already there, you can see something is awry. And so if you believe that financial orders can change, that's the first thing. And then the second thing is why is it changing, and understand it, then the Bitcoin theory becomes so obvious. And so what happened from 2008 and on, the Federal Reserve adopted what we now commonly call as an ample reserve system or an ample reserve regime, which is really at the core challenging the role of interest rates, right? Because back then, before the ample reserve construct, the way that banks would pledge their paper to the Fed to earn a rate was really determined by the market itself. And so the bank reserves were priced accordingly to what was available by demand and supply. And so the Fed really would have to control that market dynamic to set the interest rate policy that they want. But post 2008, what has happened really, and actually has been doubled down upon since 2019, is they are essentially fixing the rate by decree, and they will provide ample reserves that banks can put indefinite money across here to the liability stack and push out that rate, which means this rate is no longer determined by the market. It is literally determined by a human, by decree. And when you introduce those kinds of artificial technocratic manipulation, you can do a lot of things. So it really isn't an accident that the reserves grew. it just got untethered and unanchored to what markets should be rationally pricing. And so, well, how do you fight back? You have to fight back abundant liquidity. And the opposite side of abundant liquidity is scarce liquidity. And the only way to have scarce liquidity is to actually have collateral and commodities that cannot be printed out of thin air. You know this very well. We all believe this is why the Bitcoin thesis is so profound.
So gold breaking out is the warning shot. Bitcoin is the response, and history says it doesn't take long for that response to show up. When politicians lean on the Fed to solve everything with the printer, the market looks for assets outside that game. And here's the bigger backdrop. For the first time since 1996, foreign central banks now hold more gold than US Treasuries as a percentage of their reserves. This is likely the beginning of one of the most significant global rebalances we've experienced in recent history. It means the world is rebalancing away from US debt and into neutral monetary assets. The last time we saw a structural move like this was in the 1970s. Inflation was sticky, trust in the dollar was weakening, and investors, sovereign and private alike, fled into hard assets. If you think that trend ends here, history says otherwise. Now imagine even a fraction of that gold bid extending into Bitcoin, the asset with a smaller float, harder cap, and digital portability. And it doesn't need to match gold's $24 trillion market cap to reprice dramatically. A sliver of that rotation would be enough. And Jeff Park makes the case that sovereign adoption of Bitcoin isn't just possible, it's inevitable. But he doesn't see it as a rogue executive order. He thinks it will likely require coordination with US allies like Japan.
It will be inevitable that governments will buy Bitcoin on their balance sheet. This is something I feel very strongly, but I do also think we have to be patient about it, where it is not likely a rogue decision. So the view that I've shared in the past with others is because the US is one of many in its global alliance across the trading partnerships and the economic order, there is a social contract in which how we trade with countries like Japan, where the dollar serves as a role for the transfer of goods and capital. And in an ideal fashion, if you were to adopt Bitcoin as part of your treasury asset, it would make sense to me that you do it with some global coordination with your allies, because it would be a slight betrayal of that social contract if you were to stuff, let's say, Japan with all your long-dated treasury bonds and then didn't give them a heads up and just bought Bitcoin on your own, where the very kind of crisis confidence that would otherwise arise is one where they're not being attuned to. So the signs that I think I would wait for to see when a real strategic Bitcoin reserve adoption would happen would be some kinds of global partnership dialogues that are emerging. I think Japan is the one you should be paying attention to, because they have been so far the most kind of quiet around the role of Bitcoin as a developed market. But once you start seeing Japan embrace Bitcoin, then I do think we're ready for that dialogue to happen at the country levels.
So in Park's view, when real government involvement does happen, it won't be a rogue move to gain the upper hand. He believes it will almost certainly come with global coordination, and that Japan may be the first domino. Definitely an interesting theory that I don't think I've heard before. Regardless of when or how nation-state adoption does go to the next level, in the meantime, we don't have to guess at the signals. We can zoom out on Bitcoin's price action and seasonality, which already show us where we are in the cycle. As we can see with this Bitwise chart, August and September are historically weak months for Bitcoin. And that's exactly what we're living through right now. Soft flows and choppy price action sideways to down. But the flip side, Q4 has consistently been Bitcoin's strongest stretch. October, November, and December show the highest average returns across 15 years of data. And that's where we are. Gold is breaking out to new highs. The Fed is already hinting at rate cuts, maybe as early as September. And right on cue, we're stepping into what's historically Bitcoin's strongest quarter of the year. That doesn't guarantee fireworks, but it does make for a pretty powerful setup. And here's a much needed perspective check. 1 year ago today, Bitcoin was around $57,000. Even with this recent chop, we've nearly doubled since then. And just look at the drawdowns. This cycle's biggest pullback has been about 33%. Mild compared to the deep 50% plus corrections of past cycles. Broader adoption, ETF demand, and corporate treasuries have smoothed out the extremes. In other words, this isn't the most painful cycle we've ever seen. It's actually one of the most resilient and structured. So now, sitting around $111,000, down from the all-time high of $124,000, we do have to admit that there's always the chance of going a bit lower from here. But if history is any guide, those deeper pullbacks inside a bull run often turn out to be the best buy zones. So yes, we might still need to flush out some weak hands, short-term holders panicking, and leverage longs overextending. But that's the nature of free and open markets. They tend to seek out maximum pain. But here's what stands out. Despite spot selling pressure from long-term holders, despite soft ETF flows, Bitcoin has held its ground better than skeptics admit. The spot market, the people quietly stacking real Bitcoin, seems to be carrying the load. And that tells me this is consolidation, not collapse. If you're an executive, founder, or family office watching this and realizing we need a Bitcoin strategy before Q4, this is exactly what Swan Private is built for. The Swan Private team works with corporations and high net worth clients to design long-term accumulation and custody plans. No noise, just Bitcoin. Reach out at swan.com/no-second-best to start your journey today. And if you want to meet the thinkers, builders, and policymakers shaping this future, come join us at BTC in DC September 30th and October 1st at the historic Kennedy Center in Washington. This is more than just a conference. It's where Wall Street, Washington, and Bitcoin collide. Visit btcindc.com and use code SWAN for 10% off your tickets, but move fast because they won't last. And finally, a quick shout out to Mara, the world's largest publicly traded Bitcoin miner, for supporting this show and for helping make Bitcoin the world's most decentralized and secure monetary network. So where does this all leave us? Gold is telling the truth first. It's the world's warning signal against reckless policy. And Bitcoin is the harder, scarcer, and higher beta version of the same trade. When gold rips, Bitcoin eventually follows. The ingredients are here: easier money, global rebalancing, and seasonality tailwinds. But the real question is, do you think Bitcoin's next leg up starts here, or do we need one more flush lower before the rally can take off? And what do you think about Jeff Park's nation-state adoption theory and Japan as the wild card? Leave a comment with your thoughts, like this video, share it with a friend, and subscribe to the Swan Bitcoin channel for more signal every single day. Thanks for watching, and remember, there is no second best money.